Okay, let's begin now. So today we will try to at least complete this chapter. Say yesterday we started with securitization. So I believe now you have understood the concept of securitization and how it works. This was the process that I told you. There are 3 or 4 parties involved. First is borrower and then originator, that is bank. And then bank sell all the receivables to special purpose vehicle. Special purpose vehicle will again convert all these assets into securities, which will be again traded in secondary market, and investors will buy those securities to earn the certain amount of interest or dividend. So there are 4 parties involved in this process. Okay. So yesterday only we have done how it works. So how securitization works means modus operandi. Okay. So this is just another name to, refer it to as how it works. So we have done types of securitization also. There are 5 types, that is asset-backed security, mortgage-backed. We have 2 mortgage-backed securities, residential and commercial. And we have a CDO, that is collateralized debt obligations. And we have a future of flow securitization also. So we discussed each one of them in detail. Okay. Now advantages. What are the advantages of the securitization? Now see, there will be two, two segregations here. The segregation is done on the basis of advantages to originator, that is bank, and advantages to investor. So let's see one by one. Advantages to originator. Whenever originator comes here, you have to associate it with bank, because bank give loan and they take the mortgage assets, no? And that particular asset is given to special purpose vehicle. Therefore, there are advantages to the originator. Now let's see one by one. Unblocks capital. Now see, your capital was blocked in the name of loan and in the name of mortgage assets. What will you do with the mortgage assets? What will a bank do with the mortgage assets? Rather sell it to the special purpose vehicle and you will receive cash. So you will receive cash is the another advantage. Provides liquidity because the capital is not blocked. Long-term capital, that is the mortgage assets, are not kept blocked. They are utilized in the process. Okay. So next is when they are utilized, they are sold to special purpose vehicle institution. And that institution will provide liquidity to the bank at the lower funding cost. See, that's another advantage. Lower funding cost means there is very minimum amount of commission or fees that is charged by special purpose vehicle. So it's very, it's not so costly. The process requires very minimum amount of money that has to be paid by the bank for the process. Okay. Next, risk management. Risk can be managed easily because you have cash now. So you can manage your risk very easily. Why? Because now you have sold those assets to somebody else. Now, those assets are to be converted into securities by that particular institution, which is known as SPV, special purpose vehicle. Now they will look after to that particular asset. Okay. And in fact, these assets are converted into securities so that it can be sold and traded in the secondary market. So that there is one more advantage to manage the risk. I mean, there is one more factor which becomes very easy to manage the risk, because these are converted into securities. They are not blocked. And therefore, if they are converted into securities, that can be traded in the market. So investors will purchase the securities. So again, we will receive cash and the capital will not be blocked. So this is how risk can be managed. Overcoming profit uncertainties. So suppose if you are undergoing losses, that problem can be overcome. That problem can be solved. Am I right? This problem can be overcome. So if you need to solve your problems of losses, if you're suffering losses, so then you're supposed to sell all your mortgage assets and then you will receive cash. Again, you are able to give loans to public, and again you are able to receive huge amount of interest from those loans. So again, there will be profits in the company. Okay, reduces need for financial leverage. See, you if you have your own cash, why will you buy from outside? So borrowings will reduce. Financial leverage means out of my net profit, if I'm borrowing more and more, out of my net profits, major chunk goes in payment of interests to those borrowed fund holders, right? So that reduces, no, because it is my own money that is invested in the business. So there is another advantage, that we do not have to pay more and more amount of interest to the borrowed fund holders, because there are no as much as borrowed fund holders in the company, right? So it reduces the financial leverage. Next, there are few advantages to investor as well. Investor means who invest in these particular assets which are converted into securities. Quality investment, yes, because it is looked after by an institution, expert institution, which is known as um, what is known as special purpose vehicle. So it is quality investment. Less credit risk. Credit risk is not that much attached with these assets, because anyways these are assets, and they are, they have some value in the market, and therefore credit risk is not attached to them. Better returns, you will get better returns in from such type of securities. Okay, diversified portfolio, you can always choose to have diversified portfolio, because the risk becomes very low. When your funds are diversified, your risk becomes very low. Okay, benefits small investors also, because see, securities are, big assets are there, group of assets are there. Now they are divided into small groups, and therefore they if they when they are divided into small groups, what happens, they are they are divided into small number of shares. They are converted into small number of shares which are traded in the market. So small number of shares will have a very small price in the market, and that very small price can be affordable. It can be, taken or bought by the, medium term buyers, those who cannot afford high priced securities. So they can also go for buying such securities. They cannot buy assets, right? Middle class people, small investors, they cannot buy big assets, but but they can invest in securities like small securities. Yes or no? Therefore, it is benefited to small investors as well. So these were the advantages. We have few more, and it gives you explanation also. These points in the next slide, they are giving you a proper explanation. If you need, you can read it out later on, to investor and to the originator. These are the same points wherein he is trying to give you explanation. Okay. Now let's see the overall benefits of securitization. It creates liquidity. To the originator, it creates liquidity. The funds are not blocked. Okay. Financial institution can gain in securitization by interest swap, because see, in securitization means somewhere you have interest or a dividend attached with the securitization process. So if you have a swap means derivatives mein aapne padha hai, swap. So suppose fluctuating interest rates are there and fixed interest rates are there. So the one who carries fixed interest rates and the one who carries fluctuating interest rates, they both can have a swapping between each other. So in this process, somebody will gain. Somebody will gain. Somebody will, make profits if they are entering into the process of interest swaps. So this process is involved in securitization also. Okay, it enables the lending institution to improve their liquidity, because now cash is immediately received after the originator sell all the assets to the special purpose vehicle. From the long term assets, funds are raised. Now these are long term assets, no, that a bank has. Funds can be raised. How these funds are raised? By converting them into securities and selling them to investors. Funds can be easily raised. As the asset structure and volume are reduced, asset structure will reduce, no? Assets are sold to special purpose vehicle. These assets are sold to special purpose vehicle. Now in the balance sheet, such type of mortgage assets will not be reflected. Volume will be reduced. Therefore, capital adequacy ratio is increased. Why? Because I received cash, no? I received capital. So capital will be increased. And because of this, risk will be reduced on assets. Why? Because I sold these assets on to the special purpose vehicle. Therefore, risk in my balance sheet will be reduced. Okay. Next, financial institution is able to get a better credit ratings. Why? Because the liability is decreasing. The liability is gradually decreasing and capital is increasing. And therefore, the capital, the goodwill is increasing. And therefore, credit rating companies will give you better ratings. Okay. So, these were few benefits, overall benefits that an institution may have. And these were the benefits which were divided into two criteria based on advantages to originator and advantages to investor. This is again same thing, but they are asking in a question format. So explain benefits of securitization for economies and financial markets. See, allow investors to have more legal claims on loans and portfolios of the receivables. Investors can access securities matching their risk, returns, and maturity needs, because you have so many options here. Okay. Allows for creation of tradable security. Means now assets are converted into securities which can be traded, and you can receive cash. You can generate cash from such assets. So it creates liquidity. Can help government privatize public assets also. So suppose government is not able to look after to such assets, public assets, like public parks and all. These are the assets for government, right? But then they can privatize that also. Okay. If they undergo securitization process. There are few disadvantages also. Every coin has two sides, right? So if we have some advantages, disadvantages will also be attached. Let's see few of them. Lack of transparency. Now there is a bit problem of transparency. There is no transparency system here. So you will not be able to come to know that which type of asset and which type of asset is not there, or invest, how old the asset is. You will not be able to know that. Okay. Quite expensive. This process is expensive. Why? Because there are many parties involved in between the process. So special purpose vehicle will charge its own fees, and then there are investors who will wish to have some more interest and dividend in the process. Okay, bank will charge interest amount on loans from the customer. So there are parties involved, and therefore the process becomes very expensive. Inaccurate risk assessment. Sometimes risk management becomes very, very difficult. Therefore, the measurements that are taken becomes inaccurate sometimes. Okay. Complex to handle because the system is very, complex, very difficult, very long procedure. Assets, big assets are involved. Huge amount of assets are involved in the process. Therefore, it is complex to handle. Investor bears risk. Ultimately, who has to bear the risk? Those who are purchasing the securities, investors. So they will have to bear all the risk. Next, loss from the prepayment. Suppose if you're prepaying the amount and in the future the value is decreasing, then there are losses also. There are chances of losses also, which may occur to the investors. Okay. So there is again an explanation for all the points that we have covered here. Are you getting my point? Students, have you understood advantages and disadvantages?
Yes, ma'am.
Okay. Issues in securitization. What are the problems that you face in securitization? See, SPV splits various assets into different types of securities, as we know. Assets are converted into securities, right? According to their maturity date, interest rates, risk and returns portfolio, risk and returns factors. SPV, these are the factors that, will have to be kept in mind by SPV while splitting various assets into different types of securities. So if suppose if you do not properly match your maturity dates, you do not set the maturity dates properly, then investor will not purchase. Because if they want for 3 years, and if you have kept all the securities for more than 3 years, then few investors will be discouraged to buy such securities. So you have to think and accordingly make the process, the convert the assets into securities. Next, SPV issues securities to investors, which are as follows. There are few, issues that are divided into 4 parts: pass-through certificates, pay-through certificates, interest-only certificates, principal-only certificates. These are the main 4 issues that you face while issuing securitization. Let's see one by one. Pass-through certificates. What happens in pass-through? In case of pass-through certificates, payments are received from the assets such as housing loan, from out of which payment for certificates of deposits are met as and when they are due. Now, suppose if you have certificates of deposits, COD. Do you know what is COD? Certificate of deposits?
Yes, ma'am.
Yeah, bank is issuing certificates of deposits, right? A company can also issue. So if you have, suppose if a bank has certificate of deposits, now you have to make a payment of certificates of deposit. So as and when that will due, the payment of these assets will also be done at that time only. So it is linked with the certificates. Which type of certificates? Certificates of deposits. Okay, next, pay through certificates. Now, what do you mean by pay through? This is pass through certificate. This is pay through certificate. In this case, multiple maturity structure certificates, depending upon the maturity pattern of various assets, will be issued. Now, what will happen? There are many assets which have different maturity patterns. 3 years, 4 years, some have 5 years, some has 10 years. So depending upon their maturity patterns, they will be linked with certificates of deposit, so that it will be linked in the manner in such a way that as and when the assets mature, the respective certificates will be paid. Okay, so suppose maturity comes after 3 years. So certificates will be paid. The payment will be made according to the maturity date. Here, the maturity is not important. Here, certificates of payment ka date, due date is important. Are you getting my point? The difference between the two? Students, have you understood?
Yes.
Okay, very good. Next, interest only certificates. Now, what will happen here? only interest only, the name itself suggests the meaning. The interest for these 6 certificates will be paid as per the earning from assets securitized. That means out of these certificates of deposits, whatever interest is due, whatever interest that a bank has to pay, it will be decided according to the earnings of assets securitized. Okay, so only interest will be paid. Next, only principal amount. So only principal amount will be paid on the certificates from the realization of assets. So suppose assets are realized, assets are sold. Now, what will you pay? Only the principal amount of the certificates of deposits. Okay. Now, did you understand the whole part? Any doubt? Do you have any doubt?
No doubt.
Okay. Let's go to the next slide. Difference between securitization and factoring. See what happens, no? Securitization may all the assets, long-term borrowers, long mortgage company, loan mortgage company will have long-term borrowers like 10 years, 4 years, 5 years, 15 years. Like that, you will have long-term borrowers in your receivables. In your receivables. You will, you will sell all these receivables to special purpose vehicle who will pay you the installments. And what they will do? You will sell all these receivables to the SPV, no, at discount, who in turn issue bonds on the securities on these receivables. Because these receivables are converted into securities, bonds, debentures, and that are issued to your company. And you can sell it in the market again to earn the profit when the value of such securities increases. Whereas in factoring, yes, it involves unblocking the funds. I know. Same. You can sell all the receivables to the factor. Yes. You can unblock all the funds which are blocked in the receivables. Yes, that is same part. But instead of issuing the bonds, the companies outsource these receivables to factor agency at the discount. No, you will not issue bonds. You will not convert them into securities in the process of factoring. Whereas what will you do? You will outsource these receivables. You will sell it to somebody else at a discounting rate and take the money immediately. The whole money is received on the spot. So this is the basic difference between securitization and factoring. Okay. Next point. Factoring is a purchase of receivables of a company and liquidate these receivables to manage company's cash flow with or without recourse. As you know, all the receivables will be purchased and you will give them cash. It can be with or without recourse. Okay. But what is securitization? It is a process to convert illiquid assets into liquid assets. Okay, and those liquid assets how it happens? By converting them into securities that can be traded in the market, and it is always without recourse. Factoring is, it can be with or without recourse. Securitization is always without recourse. Next, factoring comprises of selling of companies receivable to third party for quicker payment, usually at a discount. Whereas securitization involves converting long-term duration cash flows into short-term duration. Because long-term means assets, land and building, plant and machinery, loans, long-term loans. And short-term duration means security, share, debenture, bonds, etc. Factor is done for short-term assets like receivables, debtors, and bills receivables. Whereas securitization is done for longer term assets like land and building, long-term loans, mortgaged assets. Are you getting my point now? Did you understand all the differences between securitization and factoring? Students, at least say yes or no. Did you understand? Maima, you're not audible, Bacha. You can write it in the chat box anyways. Did you understand? Any doubts? Okay, good. So let's go to the next slide, features. This is the last point that a chapter has and we are done with the chapter. Only 4 features are there. Now let's look at one by one. Marketability. Now what do you mean by marketability? Can you buy and sell big assets every day? Quickly? No. If they are converted, if they are entering into the process of securitization, then it can become, it can be converted into such securities which are easily marketable. So marketable means you can easily buy and sell it in the market as and when you want. Okay, so they become marketable. They can be quickly, easily sold and bought in the market. Merchantable quality. The quality is very good. It is saleable. Okay, the process securitized product should be saleable quality. This concept in case of physical goods is something which is acceptable to merchants in normal trade. Now, when you convert such assets into securities, it becomes a financial product. It becomes a financial instrument. It is associated, embodied with the instruments, means it is combined with the instruments in the market. And then they are sold to the investors according to their maturity dates, to match their maturity dates, to match their risk and return factors. So you can easily, buy and sell it to the investors according to their, objectives. Okay. Next is you have wide distribution. These products can be distributed widely. Why? Because you have achieved a factor which is known as, conversion of assets into securities. So that can be issued at a larger level in the market. It is traded in the secondary market. So anybody can buy and sell it according to their investment objectives. Commoditization. Commoditization means securitization is a process of commoditization, where the basic idea is to take the outcome of this process into capital market. That means you are taking it out from the long term and bringing it to short term market, so that it can be easily sold it and placed it in the market. Okay, so because see, assets cannot be easily purchased and sold in the market, but then yes, if you want to quickly sell and purchase and receive liquidity in the company, gain liquidity in the company, so you will have to convert them into such things which are related to financial instruments, which becomes your part of money market, and that can be easily sold and bought in the market. Okay, so did you understand the chapter? Any doubts? I hope you all are understanding.
No, ma'am, no doubt.
Okay, so we have done this chapter. Now 2 more chapters that are pending in our what to say, FSM, and that is housing finance, very small chapter, and consumer finance, very small. These are very small chapters. So we will quickly complete with these chapters in next upcoming lectures, and then in the last we will begin with FRA's last chapter, that is insurance final accounts. That is also very easy, don't worry. Okay. Okay, so I think we can wind up for the day.
Yes, ma'am. Bye, ma'am.
Okay, bye. Take care, everybody. Bye.